Welcome to the Credit and Debt Management Workbook. Have you ever checked your bank account and thought, wait, where did all my money go? Managing money can feel like trying to hold on to soap in the shower. But it just slips away before you realize what's happening. But here's the thing, credit and debt aren't the villains. The real problem is not knowing how to manage them properly. Today, we're going to break down credit and debt in a way that actually makes sense. No more confusing financial jargon, just real practical knowledge that will help you keep more of your hard earned money. Together, we'll master the art of smart spending because managing credit and debt isn't just about numbers, it's about securing your financial future. Now, let's take a look at what's on today's money menu. Think of today's session as your financial survival guide. By the end, you'll be able to confidently make financial decisions. We'll be covering 6 key areas. First, we'll talk about the right money mindset because wishful thinking doesn't pay bills. Then, we'll move on to credit cards and how to use them wisely. Next, we'll break down how credit actually works, including interest rates and loan terms. We'll also dive into credit scores and why they matter. Then, we'll look at managing debt and how to break free from the cycle of constant payments. Finally, we'll discuss student loans in Part 6. Because knowledge is power, but debt shouldn't be. Sounds good? Let's go. Welcome to the first part of the Credit and Debt Management Workbook series. Today we'll talk about the first part, which is the approach to credit and debit. In this presentation, I'll be going over the key definitions, the pros and cons of using credit, the difference between good debt and bad debt, managing debt load, the strategies to reduce your debt ratio, and then I'll end it off with the key takeaways and a summary. You can also follow along and complete the worksheet provided for this module. Now I'm going to talk about some key definitions. But before we dive in, let's make sure that we're all speaking the same financial language. Credit is when you borrow money with a promise to repay it later, often with interest. It's basically a future use problem. Next off, debt is the money that you owe. It's like that one friend who never lets you forget that you borrowed $5 in 2015. A loan is a structured form of debt with a set repayment plan. Think of it like paying your utility bill late. If you don't pay on time, the amount is going to keep on growing, making it even harder to catch up. Now that we got that down, let's talk about how to use credit without regretting it later. Now I'm going to talk about the pros and cons of using credit. Credit can be a powerful tool or a financial headache. It all depends on how you use it. Some of the benefits of a credit include the ability to buy something now and pay for it later, which can be really useful in emergencies. Using credit responsibly also helps you to build a strong credit history, which makes it easier to qualify for loans, apartments, and even jobs. Plus, many credit cards offer rewards like cashback or travel points. But credit also has its own downsides. If you don't budget properly, it can feel like shopping with free money until the bill arrives. Interest rates can also turn a $100 purchase into a $200 problem if you only make the minimum payments. And if you use credit recklessly, it can become very overwhelming and hard to manage. So the bottom line is, credit is like fire. It can help you cook up opportunities, like building a good credit history, but if you're not careful, it can get out of control and cost you more than you planned. So, use it very wisely. Now I'm going to talk about the difference between good debt and bad debt. Debt gets a bad reputation, but the truth is, some debt can actually work in your favor. Good debt includes things that can help you build wealth over time. A mortgage is a good example of good debt because owning a a home can be a valuable investment. Student loans can also be a good debt if they can lead to a higher paying career. In addition, business loans business loans can be beneficial if they help you grow your income. On the other hand, bad debt can drain your money without adding value. Maxing out a credit card for a luxury item you don't need is a bad debt. Taking out a loan for a vacation might create good memories, but it can also cause interest payments. Buying the latest iPhone on credit when your current one still works is another example, especially since Apple will release a new one next year anyway. However, a good rule of thumb is that if the debt helps you grow financially, it's good. But if it makes your bank account smaller, it's considered as bad. Now I'm going to talk about managing debt load. How much is too much? Ever feel like your paycheck disappears faster than your phone charger when you actually need it? Let's talk about how much debt is too much. A good guideline is to keep your consumer debt, like your credit cards, below 15 to 20% of your gross monthly income. Your total debt, including loans, should stay below 35% to 40% of your income. For example, Jackson and Oliver earn $4,200 per month, while they have debts such as a mortgage for $1,400, student loans for $300, and personal loans for $250. If we add up their debts, their total debt payments add up to $1,950. That means if we use the debt to income ratio formula, which is the total monthly debt payments divided by the total monthly income, and then multiply that ratio by 100 to get the debt to income percentage. After using this formula, we can see that their debt to income ratio is 46%. That's too high and can lead to financial stress. Now, let's do an example of a debt to income ratio, but this time I will let you solve it. The problem is, Maria and David earn $5,600 per month before taxes. They have the following monthly debts, the first one being a mortgage for $1,800, the second one being credit card payments for $400, the third one being an auto loan for $350, and a personal loan for $300. The question is, what is Maria's and David's debt to income ratio? The formula is the debt to income ratio equals the total monthly debt payments divided by the total monthly income and multiply that ratio by 100. The options are, option A is 45.5%, option B is 50.9%, option C is 60%, and option D is 35.5%. The second question that I also want you to answer is, which of the following statements is true about their debt load? Option A is, their debt to income ratio is below the recommended healthy range, below 36 to 40%. Option B is, their debt to income ratio is too high, indicating that a large portion of their income is going towards debt repayment. Option C is, their debt to income ratio is excellent, showing that they're managing their debts really well. Option D is, their debt to income ratio is manageable, but they should consider paying off some debt. Please pause the video and take a few minutes to answer the questions. Once you have answered the questions, unpause the video and I will show you the answers. Okay, let's go through this example together. The first step in calculating the debt to income ratio is to calculate the total monthly debt payments. This can be done by adding up the mortgage debt, credit card payments, auto loans, and personal loans. But specifically, you need to add up $1,800 plus $400 plus $350 and $300. Altogether, the final sum would be $2,850. The next step is to calculate the debt-to-income ratio by finding the ratio by dividing the total monthly payments by the total monthly income. In this case, the total monthly debt payments was the sum that we calculated from the first step, and that was $250. Using that number, we will divide it by $5,600, which is David's and Maria's income before taxes. Then, we will multiply that ratio by 100 to get a debt-to-income ratio as a percentage. The final calculation would be $2,850 divided by $5,600, and then we multiply that ratio by 100 to get the final result of 50.9%. Therefore, the correct answer for the first question was option B, 50.9%. The correct answer for the second question is option B, which is their debt-to-income ratio is too high, indicating that a large portion of their income is going towards debt repayment. When a debt-to-income ratio is above 40%, it is considered high, which means a large portion of the income is going towards the debt payments, which may affect financial stability. Therefore, we can see that the debt-to-income ratio is too high in this example, and if half your income is going towards debt, it's very hard to save for the future, and we want you to enjoy your money, not just give it all to the bank. Now I'm going to talk about the strategies to reduce your debt ratio. If you're dealing with too much debt, do not panic. There's always ways to turn it around. First, you want to list all your debts, which means you want to start by cataloging your debts with amounts, due dates, and interest rates. Then, you want to focus on paying off your high interest debt first. Usually your credit cards have the highest rates. You also want to negotiate with creditors for better repayment terms. You can also ask for lower rates and more flexible terms from creditors. Another option is debt consolidation, which combines multiple debts into a manageable payment. And most importantly, it's important to stop taking on new debt unless absolutely necessary. Every small step adds up. Your future self will thank you if you follow these strategies. Now I'll talk about the key takeaways from this presentation. But it's always remember to always keep your debt under 40% of your income. And use your credit wisely. It's a tool, not free money. It's also important to pay off your high interest debt as soon as possible. And most importantly, make budgeting a habit, not a punishment. Keep your debt ratio within or less than 35 to 40% of your income. It's also important to focus on good debt, which means prioritizing borrowing that adds longer-term value. And last but not least, avoid bad debt, which means minimizing the borrowing for depreciating items. The key to financial success isn't about how much you make, it's about how well you manage it. Money doesn't have to be stressful. The more you know, the more control you have. And that is the real secret to financial freedom.